Welcome to Journey Realty Group. Today we're diving deep into an exciting and often overlooked strategy for building long-term wealth, investing in real estate using a self-directed IRA. Now, you might be wondering, what exactly is a self-directed IRA and how can it help me invest in real estate? That's exactly what we're here to explore. Whether you're an experienced investor or just getting started, this method can provide significant tax advantages and allow you to diversify your retirement portfolio beyond traditional stocks and bonds. Most people think of retirement accounts as a place to invest in stocks, mutual funds, or bonds. But what if I told you that your retirement savings could be used to purchase rental properties, commercial buildings, or even land without dipping into your personal savings? That's the power of a self-directed IRA, SDIRA. By the end of this video, you'll understand exactly how an SDIRA works, the different types of real estate investments you can make, the rules and regulations you must follow, and how to set yourself up for success. So let's get started. What is a self-directed IRA? A self-directed IRA, SDIRA, is a retirement account that allows you to invest in alternative assets, including real estate. While traditional IRAs and 401ks limit your options to stocks and bonds, an SDIRA gives you much more flexibility in how you grow your retirement wealth. So how does it work? Unlike conventional IRAs that are managed by brokerage firms, SDIRAs are controlled by custodians who enable investments in non-traditional assets. But here's the key difference. You, not a fund manager, decide how your retirement funds are invested. This means you have direct control over selecting and purchasing real estate within your IRA. Let's break it down with an example. Imagine you have $200,000 sitting in your 401k, invested in mutual funds. You decide to roll those funds into a self-directed IRA. Now, instead of being tied to the stock market, you could use that money to buy a rental property. Let's say you find a $150,000 single-family rental home in a growing market. You purchase it using your SDIRA, and after expenses, you make $1,500 per month in rental income. The best part? That income goes back into your IRA tax-deferred or tax-free, depending on the type of account you have. So not only do you own a tangible asset that appreciates over time, but you're also earning passive income while preparing for retirement. But before you jump in, there are rules to follow and key benefits to consider. Now that we understand what a self-directed IRA is and how it allows you to invest in real estate, let's talk about why this strategy is so powerful. Investing in real estate through an SDIRA comes with several unique advantages, including tax benefits, portfolio diversification, passive income growth, and greater control over your investments. Let's break down each one. Benefits of investing in real estate with a self-directed IRA.
How one?
Tax advantages. One of the biggest reasons investors choose an SDIRA for real estate is the tax benefits. Depending on whether you use a traditional SDIRA or a Roth SDIRA, your investments grow either tax-deferred or tax-free. With a traditional SDIRA, you contribute pre-tax dollars, which means you only pay taxes when you start withdrawing funds in retirement. With a Roth SDIRA, you contribute after-tax dollars, but your investments and all profits, such as rental income and appreciation, are completely tax-free when you retire. Example, let's say you invest in a rental property through a Roth SDIRA, and over 20 years it appreciates from $150,000 to $400,000. When you sell it, you pay zero in capital gains tax. Portfolio diversification. Relying solely on the stock market for retirement can be risky. Real estate provides a tangible asset that helps diversify your portfolio. Unlike stocks, which can fluctuate daily, real estate typically appreciates steadily over time. Real estate investments can serve as a hedge against inflation. While cash loses value over time, property values and rental income usually increase. 3. Passive income growth. Rental properties generate consistent cash flow, allowing your SDIRA to grow faster. The rental income from properties owned by your SDIRA must be deposited directly into your IRA. That income can be reinvested into more real estate deals, compounding your wealth over time. Example, If you buy a duplex using your SDIRA and earn $2,500 per month in rent, that's $30,000 per year growing tax-free or tax-deferred inside your retirement account. 4. Greater control over investments. With traditional IRAs, your investment choices are limited to whatever mutual funds your broker offers. A self-directed IRA, on the other hand, puts you in control. You decide which properties to buy, what markets to invest in, and how to maximize your returns. Instead of relying on a fund manager, you can leverage your real estate knowledge to grow your wealth on your terms. Types of real estate you can invest in with an SDIRA. One of the best things about using an SDIRA for real estate is the wide range of investment options available. Let's explore some of the most common choices. Rental properties. Buying single-family homes, duplexes, or apartment buildings is one of the most popular SDIRA investment strategies. Example, you buy a $200,000 rental property with your SDIRA. The property generates $1,800 in rent per month, which goes straight into your IRA. Over time, the property appreciates, and by the time you retire, it's worth $350,000, all tax-free if you used a Roth SDIRA. 2. Commercial real estate. Investing in office buildings, retail centres, or warehouses can generate higher rental income than residential properties. These leases are typically longer term, meaning fewer vacancies. Businesses often take better care of the property, reducing maintenance costs. 3. Vacation rentals and short-term rentals. Airbnb and short-term rental properties can offer higher returns than traditional rentals. However, there's an important rule. You cannot personally use any property owned by your SDIRA, not even for one night. Example, if your SDIRA owns a beach house listed on Airbnb, you cannot stay there yourself. Violating this rule can result in serious tax penalties. 4. Raw land and development. Buying undeveloped land can be a great investment, especially in growing areas. You can sell the land at a higher price later, or lease it for farming, solar energy projects, or commercial development. 5. Real estate syndications and REITs. If you want a more hands-off investment approach, you can use your SDIRA to invest in real estate syndications, where multiple investors pool funds to buy properties. Real estate investment trusts, REITs, which function like stocks but invest in real estate. This strategy allows you to benefit from real estate without direct management responsibilities. Now that we've covered the benefits of investing in real estate with a self-directed IRA and the different types of real estate investments you can make, it's time to talk about something crucial: the rules and regulations you must follow. While an SDIRA gives you more control over your retirement investments, it also comes with strict IRS guidelines. Failing to follow these rules can result in severe tax penalties, including the disqualification of your IRA. Let's break down the most important rules and some common pitfalls to avoid. Rules and regulations you must follow. 1. Prohibited transactions. The IRS has clear rules to prevent self-dealing, which means you cannot personally benefit from any property owned by your self-directed IRA. Here's what you cannot do. You cannot buy a property from or sell it to yourself. You cannot live in or personally use any property owned by your SDIRA, even for one night. You cannot rent a property to family members or business associates who are disqualified persons. The IRS considers certain individuals disqualified from transacting with your SDIRA. These include yourself, the account holder, your spouse, your parents and grandparents, your children and grandchildren, any entity, business, LLC, or trust that you or a disqualified person owns 50% or more of. Allowed transactions. You can buy real estate from an unrelated seller, rent to tenants who are not family members, and use an independent property manager to handle maintenance and payments. Example of a prohibited transaction. Let's say your SDIRA owns a rental property and you decide to rent it to your son at market rate. Even though you aren't giving him a discount, this is still considered self-dealing, and the IRS could disqualify your entire IRA. That means the full value of your account could become taxable immediately. 2. All expenses must be paid from the IRA. When you own real estate in a self-directed IRA, all expenses must be paid using IRA funds. Permitted. Mortgage payments, property taxes, repairs, insurance, and maintenance must all come from the IRA's funds. Not allowed. You cannot pay these expenses with personal funds, even temporarily. Example: your SDIRA owns a rental property and the HVAC system needs a $5,000 repair. You're short on cash in your SDIRA, so you pay for the repair using your personal checking account. Unfortunately, this violates IRS rules and your IRA could be disqualified. To avoid this, always ensure your IRA has enough liquidity to cover unexpected expenses. No sweat equity. You cannot perform repairs yourself. When you own real estate in an SDIRA, you cannot perform any physical labor or repairs on the property. You can hire a contractor or property manager. You cannot paint, fix plumbing, replace windows, or mow the lawn, even for free. Why? The IRS considers this an indirect contribution to your IRA, which is prohibited. Your role must remain passive and all work must be done by third-party professionals. Example: let's say your SDIRA owns a rental property and the roof needs repairs. If you personally fix the roof instead of hiring a contractor, you are violating IRA regulations, which could result in tax penalties. 4. Understanding UBIT and UDFI taxes. While SDIRAs allow tax-advantaged real estate investing, certain situations can trigger taxation. If your IRA purchases a property outright with cash, you typically won't owe taxes on rental income or capital gains. If your IRA uses a mortgage loan to buy a property, part of your earnings may be subject to unrelated business income tax, UBIT, or unrelated debt-financed income, UDFI tax. Example: if your SDIRA buys a $200,000 rental property with $100,000 cash and $100,000 in non-recourse financing, approximately 50% of the rental income may be subject to UBIT. This doesn't mean financing is bad, it just means you should consult a tax professional to ensure you plan accordingly. Common pitfalls to avoid. Now that we've covered the major IRS rules, let's talk about some mistakes investors make when using a self-directed IRA for real estate. 1. Not choosing the right custodian. Not all custodians allow real estate investments. Some charge high fees for transactions, account maintenance, or asset purchases. Always research and choose a reputable SDIRA custodian that specializes in real estate. 2. Not keeping enough cash reserves in the IRA. Real estate investing comes with unexpected expenses, vacancies, repairs, legal fees. Since all expenses must be paid with IRA funds, it's crucial to keep a cash reserve in your account. 3. Violating the rules by accident. Even an innocent mistake, like paying a property tax bill with personal funds, can lead to severe IRS penalties. Always consult with an experienced tax advisor or custodian before making financial moves. We've covered what a self-directed IRA SDIRA is, the benefits of using one for real estate investing, and the crucial IRS rules and common pitfalls to avoid. Now, let's walk through the step-by-step process of setting up and executing your first real estate investment using an SDIRA. If you're ready to take action, this section will give you everything you need to know, from opening an account to managing your property successfully. Step 1. Choose the right self-directed IRA custodian. Unlike traditional IRAs, SDIRAs must be held by a specialized custodian. This is a financial institution that administers your account, ensuring compliance with IRS rules. When choosing a custodian, consider investment flexibility. Do they allow real estate investments? Fee structure. What are their account maintenance, transaction, and asset holding fees? Customer support. Do they provide investor-friendly support? Speed of transactions. How long does it take to process a real estate purchase? Some of the well-known self-directed IRA custodians include Equity Trust and Trust Group, UDirect IRA Services, New Direction Trust Company. Tip: before opening an account, compare multiple custodians and read client reviews. Step 2. Open fund your self-directed IRA. Once you've selected a custodian, you'll need to open and fund your SDIRA. You can do this in 3 ways. Direct contribution. Make an annual contribution, subject to IRS limits. Roll over from an existing retirement account. Move funds from a 401k or another IRA into your SDIRA. Transfer from another IRA. If you already have a traditional or Roth IRA, you can transfer funds without tax penalties. Example, if you have $150,000 in a 401k from a previous employer, you could roll it into a self-directed IRA and use it to buy real estate. Important note, if you're rolling over funds, make sure to follow the IRS rollover rules to avoid penalties. Consult with your custodian or financial advisor before making a move. Step 3. Identify and secure your investment property. Now that your SDIRA is funded, it's time for the exciting part, finding the right property. Research markets. Look for areas with strong rental demand, job growth, and property appreciation. Choose the right type of property. Single-family homes, multi-family units, commercial buildings, raw land, etc. Analyze potential returns. Calculate rental income, expenses, and long-term appreciation. Work with professionals. Since you cannot directly manage your property, work with a real estate agent, property manager, and attorney. Example investment. Let's say you use your SDIRA to purchase a $200,000 rental property in a high-growth city. The home rents for $800 per month equals $21,600 a year. Property expenses, taxes, insurance, maintenance, a year. Net income to your IRA, $15,600 a year, growing tax-deferred or tax-free. Step 4. Purchase the property through your SDIRA. Unlike buying property with personal funds, purchasing real estate through an SDIRA has a specific process. 1. Make an offer. The contract must list your SDIRA as the buyer, not you personally. Example, wrong, John Smith, correct, XYZ Trust Company, custodian FBO John Smith IRA. To submit paperwork to your custodian, your SDIRA custodian will review and approve the transaction. 3. Fund the purchase. The custodian will send the payment directly from your SDIRA account. 4. Title and deed ownership. The property must be titled in the name of your IRA. Important reminder, you cannot sign the contract personally, your custodian does. All income and expenses must flow through your SDIRA. Step 5. Manage and grow your investment. Since IRS rules prohibit self-dealing, you must follow these steps to properly manage your SDIRA-owned real estate. Hire a property manager. They will handle rent collection, tenant issues, and maintenance. Keep a cash reserve in your SDIRA. This ensures you can cover unexpected repairs. Reinvest profits. Use rental income to purchase more properties within your IRA. Example, growth strategy. Year 1, buy a single-family rental for $150,000. Year 3, use accumulated rental income to purchase another property. Year 10, own 3 to 4 properties, generating tax-free income for retirement. Final thoughts and key takeaways. Investing in real estate with a self-directed IRA is a powerful wealth-building strategy, but it requires careful planning and compliance with IRS rules. Key takeaways. A self-directed IRA allows you to invest in real estate, land, and commercial properties. You get tax advantages, either tax-deferred, traditional SDIRA, or tax-free Roth SDIRA. You must follow strict IRS rules, including avoiding self-dealing and ensuring all expenses are paid by the IRA. The process involves choosing a custodian, funding your SDIRA, purchasing property correctly, and managing it through third parties. Long-term success comes from choosing the right investments, keeping cash reserves, and reinvesting profits. Let's hear from you. Are you considering investing in real estate with a self-directed IRA? Have any questions or personal experiences to share? Drop a comment below. We'd love to hear from you. And if you found this video helpful, hit that like button, subscribe to Journey Realty Group, and turn on notifications so you never miss an update on smart real estate investing strategies. Thanks for watching, and I'll see you in the next video.